reality is that tech problems, really, today aren't really much different than what's been plaguing the group all year. Investor focus clearly has been shifting, shifted since November 9th when we got those initial, Pfizer vaccine headlines. But the issues for tech, they remain fading of COVID tailwinds, high expectations and difficult comps in the quarters ahead, elevated multiples, and lastly, rising yields, which obviously members of the Fed and Yellen have made a lot more noise this week as well on that front in terms of where interest rates may be heading. So again, you got the four major issues that have been kind of the headwinds for the tech sector. They aren't going away, and I think there's many, not many. There's clearly a increasing camp that views that spectacular Q1 results that we've been seeing are very unlikely to persist through the balance of the year. Hence, EPS season has been a massive disappointment for the tech sector, to say the least. Anything, spectacular or blowout has been generally dismissed, and any company that's missed, it's just been absolutely punished. So the tape has been telling us there's money going into other pockets of the market, and as you touched on earlier in your show, look at the XLF breaking out the new highs. Energy, XLE feels like a coiled spring, and material stocks continue to work as well. So we're seeing massive rotation, which seems to be the number one driver of all these big moves.
Amazing, right? I mean, oil prices on the rise. Maybe energy is the new technology. I mean, Tom Lee and Fundstrat putting out their daily notes or nightly notes, which are excellent, by the way, and they're showing how money does appear to be flowing from Apple to oil and gas. I mean, is that possible? Do you think the long-term trade in these tech names, Joel, which, by the way, have made a lot of our viewers and listeners a lot of money in the last few years, is it finally over for good? The big returns.
Yeah, I mean, maybe in the near term. I mean, tech is always going to remain the most overweight sector on a global basis. It's still going to be the leader in terms of disruption and just kind of, generating probably the most upside over a longer period of time. But I mean, I think you take a step back. The Nasdaq has underperformed the S&P by 600 basis points this year, and yet is still has outperformed the S&P by 15% off of March lows from 2020. So I mean, the outperformance has still been there, and I think just with the focus on vaccine progression, GDP recovery, and overall just kind of like I said, global GDP recovery, that other sectors are becoming a lot more attractive, especially with the consensus with rates are now heading in the opposite direction. And we all know that low rates and a very accommodative, Fed policy has been the number one driver of some of the moves in tech over the past decade plus. And you're just seeing a pause in that trade. But for the near term, tech probably underperforms. But over the longer term, you're clearly not going to abandon it. It's just becoming a lesser part of the portfolio.
Yeah, Jamie Dimon at JP Morgan yesterday saying, he's done with Zoom. I'm finished. He's no more Zooms. He can't take it anymore. David Solomon at Goldman Sachs says, get back to the office. The point is this, is the work from home trade. Work from home is probably coming to an end for much of our viewers. Is the work from home trade coming to an end, or is it already over?
I think it's already over. I mean, these stocks are still well where their lowest levels from just over a year ago. So, I mean, again, they produced outsized returns to say the least. But I mean, if you look at, whether it's the Pelotons, the Zoom Media, the DocuSigns, the Fastly you mentioned earlier as well, even like a name like PayPal. I mean, these stocks were huge, secular winners from COVID. Their stock prices reflected that. And now a lot of these charts just look absolutely broken. And I think you have to continue to keep an eye on Cathie Wood and her ARK funds. ARK right now is trading around 114, 115, 30% off its highs. We know that, her outside performance last year was all driven by disruptive tech. She was early on that trend, but she's still adding to these losers on the way down. And to me, that's kind of a poster child for the 2020 story momentum stocks. They've clearly lost all momentum, and yet you're still seeing some investors kind of try to catch the falling knives, and it's not working. So, people are averaging down as their losses mount, and that usually is never a great strategy when the tape's telling you something different.
Shepard Smith here. Thanks for watching CNBC on YouTube.